Hey everyone, it's Tom Kradzer with another episode of the Your Life, Your Term show. And on this one, we get a little crazy because this is the stuff we love talking about most, which might sound ridiculous, but it's around interest rates, some of the population growth going on in Canada, what's happening in the US and how that might affect interest rates here in Canada and how that ultimately affects property prices here in Canada and what's happening to the real estate market here in Canada. So we love diving into this kind of stuff. It's easy for us to talk about this stuff. We share some of the research that we've dug up over the last few months on this particular topic. So it's myself and Nick just kind of going through. We don't really have an agenda or a schedule. We have a few points to cover, but I really hope that you are also a monetary policy geek like we are and you enjoy this stuff. I think there'll be something in there for you if you are at all interested in real estate in the Canadian real estate market. Let's leave it at that. And listen, if you are listening to this and you haven't checked out the Ontario's population stats yet, you absolutely need to. If you're a real estate investor in this particular area of the country, especially, you need to check out this stuff. We have this report called Ontario's Population Explosion, The Untold Story, how Ontario's population trends are creating amazing opportunities for savvy real estate investors. And we believe once you see some of this data, your jaw will hit the floor. Maybe it's actually not going to hit the floor, but you know what I mean? Like you're just going to be in such awe when you look at this report. So you can get a copy of this report at rockstarinnercircle.com/reports. So that's rockstarinnercircle.com/reports. Looks like it's about 6 pages long. We've jammed to all the stats that we could dig up with a whole bunch of beautiful charts, all in color, including some of Ontario's greenbelt maps and how that's growing over the last few years, just so you can see how the population component of the real estate game is unfolding here in Ontario. So you can check that out or get a copy of that at rockstarinnercircle.com/reports. And listen, as you get into this particular episode, if this is something that you like hearing about, interest rates, property prices, talking about the economy here in Canada, feel free to give us feedback in any way, shape, or form on some of the social media platforms that we're on. You can always send an email in to podcast@rockstarinnercircle.com and give us feedback on this stuff. It helps guide us on what topics you'd like covered on the episodes of this podcast, especially ones where Nick and I just kind of sit down, hit record, and start going through some of this stuff. With that, let's get on with the show.
Are you ready to live life on your terms? Is it time to take charge? Real estate, business building, the economy, health and nutrition, and more. It's the Your Life, Your Term show with Tom and Nick Kradzer. Are you ready? Let's go.
Tom, can you hear me?
No, I'm supposed to say it. Nick,
I had
can
to
you
beat
hear
you
me?
to it.
No, don't. You're going to ruin it. Now we have to start again. Nick, can you hear me?
Yeah, no, I can hear you. I can't believe you still asked that.
Oh, listen. Okay, let's get started into this thing. We have a lot to go over. This stuff, I can get way off track, and we have a new mic, so I kind of have to lean forward into this mic stand. So if you can't hear me, you legitimately now, if you can't hear me, tell me if you can't hear me.
Oh, man.
So anyway, do you have any opening remarks before I get started on an epic rant of inflation and interest rates?
No. I mean, we're just in pure survival mode with everything going on. This is just a miracle that's happening.
Yeah, just so everybody's aware, I guess we're in the middle of this build for this new office, and we might have messed up our current lease, which means we might be leaving here a little sooner than we had planned, and the other office might not be completely right. We actually don't know. We don't have any answers. We don't know when we're moving.
I just thought it would be funny if the whole team showed up at the Starbucks one day because we didn't have an office for a couple of weeks. And we just had to go to the Starbucks and see the reaction when like the whole team shows up.
We should tell everyone listening to this what we, about 5 years ago when you deal with real estate, you always joke about like, well, I guess there could be a crash really at any time, even though no one really believes there could be. We're always very paranoid that there could be. It's kind of like we're, short-term paranoid, long-term optimistic. But we've always had this joke that if anyone ever shows up to the Rockstar office and there's just big chains around the door, that means the real estate market's collapsed. There are people after us and we're all just meeting at the Starbucks down the road. So if you're listening to this and you ever come to the Rockstar offices, chains around the door doesn't mean we haven't like paid rent or, whatever. It means we've made a mad dash for the or the exits. I shouldn't laugh about this stuff. I'm joking about this. We take real estate very seriously. We're here for the long haul. It's just without joking about real estate in this manner, it can drive you absolutely insane. So, with that, we are just on survival mode. And the last few weeks, we haven't done a lot of podcasts. I think we'll get back into a regular groove of them now. It's been totally Nick's fault that we haven't done any podcasts.
Usually is.
And Nick's, you just finished blaming, right before we started recording, you just blamed, what did you say to me? It's your fault that we're spending money or something.
No, I said anything expensive that we got for the office is definitely your fault.
Because we did this little vote about this chandelier that we found, and this chandelier, I think it looks like something out of Star Wars, like a Star Wars spacecraft or something. Someone else thought it looked like a shark. It's metal and lights. I don't know how it looks like a shark.
I agree though. It is the nicer one. I was just hoping that let's send it to a couple other people because I was hoping that out of the two options they were going to choose the cheaper one.
Yeah.
Out of this one.
So if you're listening to this and you come to our new office, and if we greet you, please make a big deal of the chandelier that you see in the boardroom so that we can feel like we haven't wasted our money.
You might not even be available anymore. Who knows? With all the stuff we learned about lighting, who the heck knows that this might be a miracle if we get lights in this place.
Okay, so I want to talk about one of my favorite topics, inflation. But the way I want to give some context around this is something that I always see in the papers are the destruction of the middle class, or the middle class is disappearing, or people can't make ends meet. And I just want to talk about this a little bit. Nick, I'll go on this little rant for a second before we talk about it.
You're going to do whatever you want anyway, so.
Okay, perfect. We're on the same page. So here's what I want to talk about. Whenever Nick and I see stuff in the media where it says, that people can't make ends meet, it's always frustrating to me because that seems like it's always talking about the symptom of what's going on in the world, in the money game, and not the actual problem. And here's what I mean by that. If any one of us Googles up the Bank of Canada's website, and if you go to the inflation control target page, which exists, it's like one of the primary pages on the Bank of Canada's website. So if you're in front of Google right now, or when you get home, if you're listening to this on the road or on your phone, if you Google up Bank of Canada inflation control target, you're going to find this page that basically says that the Bank of Canada has an inflation target of between 1% and 3%. And ideally, they're hitting 2%. And they have this little definition that says inflation is a persistent rise over time in the average price of goods and services, or the cost of living. And when you put this into a calculator, if you just put, let's say you take $100 and then you multiplied 100 times 1.02 and you hit the equal sign. And if you hit that equal sign 35 times, you're going to notice that the 100 turns into $200 after 35 times, which means everything in the world is supposed to double in price as per the rules of the game every 35 years. So if you're going to live to 70 years old, that means everything in your lifetime doubles twice. So if you buy a property, if your parents buy a property when you were born for $400,000, by the time you're 35, that property is likely going to be $800,000. And by the time you're 70, I was going to say 1.2 million, but no, it doubles from 800. So it goes to 1.6. Holy shit, I'm even astonishing myself at this point. Anyway, so it goes from 400 to 800. Yeah, that's right. It goes from 400 to 800. And then the next 35 years, it goes to 1.6 million.
Well, it's why you've seen crazy valuations and stuff now. I go back to the price of bread. What was the price of bread? How long ago was it? A nickel, right? It's not, if you actually think about it.
I don't know if it was a nickel in my lifetime or your time.
No, not lifetime. No, I'm talking about, but just do the math.
Yeah,
right? Because what do you pay now for a loaf of bread? It's like $5.
Yeah. Yeah, I don't actually eat too much bread anymore, so I don't know. You happen to pick one analogy that I have no clue, but I'm going to take your point on that.
Yeah, I'll ask the almighty Google.
But so yeah, everything is supposed to double twice in our lifetimes. This isn't like a surprise. So when I see people in the media or headlines say, "Oh my gosh, things are getting so expensive," it shouldn't be of any surprise. This is how the game works in Canada. This is how it works in North America. This is how it works all around the world. So the unfortunate part about what we just explained is that the Bank of Canada is pretty darn crappy at its job, and the 2% never applies evenly across the board. And not only does it not apply evenly across the board, they never really hit it right. So for example, sometimes things like real estate go up 6% a year and not 2% a year. And if you just use 6% and you see how long it takes things to double at 6% compounded, you know how long it takes to double 6% compounded? 12 years. 12 years. So if you buy that property for $400,000, in 12 years, it's now $800,000. At 6% compounded, everything doubles every 12 years. And I know I'm making major assumptions here saying that, it's 6% compounded every year evenly and there's no negative and that whole bit. I'm just using this as a way of an example to show that this whole thing about inflation, people just dismiss it like, oh, it's not a big deal. And the reason it's an absolutely huge deal is because most people's primary source of income are their salaries or wages from jobs. And from all of our analysis with the Stats Canada data, the one thing that does not seem to keep up with other or other things of value are incomes. So if you're depending on your income or your career or your salary or your wages to keep your pace of living, you're absolutely playing the game wrong. And it sucks, because I feel it sucks because that's all the middle class is taught, including myself. I was always taught, get a good job, have a good life. And then it's like, well, that's like totally bullshit.
Yeah, the thing that got it messed up is that it's actually, you're using that stated number, and that number, the way they calculate it is very interesting, and it changes, and they'll change it sometimes because they'll exclude certain goods, and sometimes they're like, well, because of the volatility in this market, we didn't take it into account. But if you look back, it was the 30s when you could buy a loaf of bread for 10 cents. And if you do that math, it's more than gone up for it's changed a lot. The rate of inflation for that's far greater.
I don't even know. What's like a loaf of bread, do you think, right now?
I mean, even I don't know.
$2.50 or something?
I guess it depends which type of bread. But I mean, you go to Cobb's, you're spending $5 or more, right? Yeah. $7, $8.
You're never going to Cobb's and spending $5.
No, but I look at the receipts when my wife goes. I check it. So we got.
I have.
How much did you spend on that bread?
I have verified.
No, but seriously, when I'm just thinking, like, even if it's $2, right? From 10 cents, it had to go to 20 to 40 to 80 to $1.60. So it happens faster. They claim the 2%, that's their target, but it's like you said, they do a bad job at it. It's not working. And then if you look at more kind of other assets, it hasn't worked that way either. Right. And a lot of raw materials haven't worked that way either, because those things of value, when the government prints money, so when we're taking off the gold standard, everyone that had some money, they're like, well, let's put it into something that's going to hold its value. So those types of things are, increased in value. And as the world developed, the demand for those types of goods went up as well. So the cost for those went, because more money went into them and there was demand for them. Like, people weren't buying diapers as a store of their money, right? So just kind of, it's just, the number changes a lot.
And were you talking to a developer recently that said, I forget who you were talking to, someone somewhere who was saying that they were building a new building and they were just shocked that, or their primary increase of the overall budget for the project was just cost of materials? Like, it wasn't, or were we both talking to someone who was just talking about the prices of like steel?
No, the one, if I remember what I think you're talking about is when there was a developer talking about the price of concrete, and I forget the number. I'm going to butcher it, but it was like something in like the last 2 years. His cost for the price of concrete went from, I think it was $9 to $14 a foot. I could be wrong, but it was like that type of jump, which was like a 50% jump just in his cost just for the concrete. And he's building, huge condo buildings. Think how much concrete they're using, right? So, and that's why he's saying, like, their margins, even though the the prices have gone up so much, their margins were actually squeezed. So developers over the last couple of years were making less because the cost of material and labor had increased so much.
I wonder if that's part of the reason why that one in Oakville, those new condos, the building 2 of that one in Oakville
district.
Yeah, they pushed it back. Remember, they were going to release it. We actually had some investors who were going to buy some of those condos, and they basically canceled building 2 and said, hey, we're just going to re-release it in the spring. I wonder if it was like cost of material.
Yeah.
Or like, because I just dismissed it to like, oh, they think they're going to make more money in the spring. But I wonder if some of their costs somewhere went up and it was squeezing their margins, so they just pushed it.
It could be. Yeah.
I mean, we don't know.
In the last 6 months, I actually don't know where the kind of raw material costs have gone. This was kind of May or June, but so I don't really know.
So here's what else I wanted to say on this whole inflation thing is the crazy part about all this is that we have been buying with investors right across Toronto. I mean, we have some investors that are buying condos in Toronto proper, but we obviously have a lot of Toronto-based investors who are buying all over the GTA. And some investors that we've been working with for some time, they're shocked at some of the prices. Like, we used to be buying a World War II style kind of bungalow on either side of the city, Nick, either in Oshawa on the east side of the city, up in Barrie, or in a place like Hamilton for like 200, and when we started, it was like 195, 205, 209. We were doing a lot of 209,000. These were 3-bedroom houses for 209,000.
Yeah, I know. Now it seems like a joke.
Now it seems like a total joke. Why we didn't buy 5 streets of it. I will never know. But now someone on our team bought this awesome home. I'm just bringing up one of Andrea's properties because it's just one that comes to mind. She bought this awesome home for $557,000. This one's particular one is in Hamilton, and she's renting it out. The total rent on it's going to be like $3,600, top and bottom kind of duplex situation. And it's interesting the response that people have when they hear that number, because some investors who've been investing in that area for a long time are like, oh my gosh, $550,000. And they can't believe it because we were buying properties out there for like 230, but that was over 10 years ago. So if you just use our basic inflation compounded every year, it makes sense that those properties have doubled. The crazy part is that if this continues, if inflation continues in the real estate asset class as it has, this $557,000 bungalow in the next 10 to 12 years is going to go over $1 million. So houses that when we were buying at $210,000, doesn't seem like that long ago, they're now on the path to be over $1 million. And there's no way that can be guaranteed. There's like absolutely no way what I'm saying can be guaranteed.
Yeah, well, like you said, the path that they go on is so inconsistent, right? So why people are, so the counter to that is people are like, well, it's totally overvalued. And, because what's happened is for a period of time, that property didn't really move much in value. But over the last 10 years, it moved substantially more, right? So we know that it's more than doubled in value in the last 10 years, right? So then a lot of people are like, well, that's a bubble, and that bubble's going to burst because of that huge increase. But it hadn't moved in so long, or had minor moves, that it really over the course of time, the increase isn't that dramatic, right? And
it's like this slow motion thing that people.
Well, and we look at all the numbers based on population and incomes in those areas and all that type of stuff. But there's something that's really interesting around. So I'm going to just change it from inflation for a second, just to bring it to housing specifically. When I looked at the numbers of housing starts, I don't know the exact area. It was in and around the GTA, and the number that came up here was about 40,000 units, and the long term, the 50-year average was closer to 30,000, but the 10-year average was more because we've been building more homes, and it's in between about 35 and 40,000 somewhere is the 10-year average, but the population growth expected. So sorry, that 10-year average is what in the last 10 years, right? So if we say it's about 35,000, we have about 350,000 new housing units that have come on the market, right? This is what I don't want to get into like exact kind of math because we're going to get a little more complicated. But let's say we have 350,000 housing units came on the market. In the 10 years prior, we grew in population. So from 2011 to 2021, we're supposed to grow in population from 6.2 million to 7.4 million. So let's say this trend continues. So the next 10,
what's that, 1.2 million? 6.2, 7.4?
Yeah, it's about 1.2. It's about 1.15.
Okay.
But let's say 1.2 million. So we have and that was from 2011. So we've already gone through a good chunk of this. It's only 2 years away, right? And we're saying the trailing 10 years, housing starts is about 35,000. So we're looking at roughly the same time frame. So we have 350,000 housing units created, but we have a population growth of 1.2 million. The average size of family size in Canada
what is it right
actually
now?
2.9. Right,
so 2.9. I thought it was going to be like 2. Oh, really? I thought you were going to say like 2.1 or 2.2.
No, I thought it'd be over. I thought it'd be over 3. But when I looked it up, I forget the source. This was a couple of weeks ago. It was 2.9. So let's say it's 3 people. So if we say that that the housing starts, 3 people is going to go into every housing start, and we have housing starts of 350,000 over the last 10 years, that's enough for 1.05 million. Except the population growth is 1.2 or 1.25. So there's a gap still of 150,000 to 200,000 people. Mm-hmm. That there's a shortage of housing supply coming onto the market. And I looked at it in another area. I won't dive into it.
50,000 or something? Whatever. Sorry, I was just trying to find out how many.
Yeah, so probably about 40 or 50,000 depending on the average family size depending on the exact number. But that's the shortage. Right. And then, I'm like, oh, it's just Toronto area. Let's look at another area. So I looked at.
Actually, that's probably how many homes exist in the town of Oakville.
Yeah,
town of Oakville.
I had that number.
Oakville's 189,000. I bet it's like 50,000 housing.
I'd be curious to see the number. Yeah. So, because I went and looked back at Waterloo, and it's the same thing in the Waterloo in the last 10 years. It was about 100,000 increase. The housing starts are roughly just over 3,000 per year last 10 years. So you're about 30,000. So if you have about 110,000 increase, you have 30,000 housing units, 3 people per, that's 90,000 people are housed. There's a gap of 20,000. What's happened in the Waterloo region in the last 10 years? Big increases in prices, right? Huge increase in demand, more people going into the area, that type of thing. So these are the gaps that we've been seeing in different areas, and it's kind of not something everyone's talking about.
It's totally crazy.
So, and that causes this. It causes the inflation you're talking about that was kind of like subtle for a while. It can kind of increase it. And I know this is a little bit different than just inflation.
It's like a slow motion train wreck. Like people don't see it coming. Then all of a sudden everyone looks around like, whoa, prices doubled.
Yeah. So this is the type of numbers that we're looking at. We're like, holy crap, this is kind of crazy. So there's just a gap in the supply, the supply.
And remember what Benjamin Tall said when we said, when we were down at that conference downtown about the immigration panel?
Yeah, he says they think the numbers are conservative.
Yeah, like for population growth via immigration.
Yeah,
the numbers are conservative.
Yeah. He said far too conservative.
Going forward, he thought they were far too conservative because he was sitting on some committee or something.
Yeah, these are numbers that we've already seen, and I guess why this is interesting to me is because people like freak out. I freak out too about the last 10 years in property prices. I'm like, this is crazy.
Why don't freak out.
Why is a property? No, I'm happy because I own properties, so it's worked out well.
And I was joking. You do freak out.
But it's been...
I mean that in a good, positive way.
No, but I look at them and I'm like, this is kind of nuts, right? And I hear when I'm at horseback riding with Ella, I hear the other parents talking. They're like, well, the prices are this. I can't believe this is crazy. And just in my head, I'm like, yeah, like they're right. It does seem crazy. But when you look at these types of things, we're seeing what these trends have produced, right? Yeah. When you're seeing that there's just been a gap, it's not just speculation.
That's what's pushing. If the Bank of Canada is trying to get 2%, but then you layer in what you're talking about, obscene population growth, they can't keep the 2%. And sometimes I struggle explaining to people why real estate always seems to move before other things. And the reason for it is because mortgages are how money is created. So the real estate market gets the new money the fastest. So when you have population growth, one of the first things that population growth requires is housing, because it's a need. So when people go out and get the housing, they create new money. So the money hits real estate first. So it drives the prices. So I find the same way when I hear people talking about like, oh my gosh, property prices are crazy. I feel like, aren't you just like, this is actually normal when you have this kind of growth. But in I guess the defense of the everyday kind of citizen of Ontario is when you're busy trying to make ends meet, trying to make your career work, you have a busy family, you're not paying attention to any of this. There's not too many people as psycho as you and I looking at population growth and Stats Canada data on this kind of stuff. So I can I can relate to people who like get serious with their careers for 10 years and then look up and are shocked at the way property prices are. But if you are listening to this and you want the Stats Canada income data compared to the house price data, you can go to rockstarinnercircle.com/reports and you can get the Destruction of the Middle Class report. That's where we took the Stats Canada data from 1969 and mapped it against house prices from the same time, just to show that on a graph on how different and crazy that looks. So if you don't have a copy of that report yet, you can get that at rockstarinnercircle.com/reports, because when you see the income and how slowly it grows as compared to real estate prices, it's absolutely insane. And Nick, here's the crazy part. If incomes don't really make a jump over the next 10 years, but you and I are kind of talking about like, yeah, maybe with population growth, if there's no big crisis of any sort, if real estate prices continue to grow at the pace they're growing, what happens 10 years from now? Because we've been talking about the $500,000 home that maybe goes to $1 million. What about the $1.1 million Mississauga home? Like, are those all going to 2.2? Like, what the heck is happening? And the crazy part is that this whole inflation thing. It's part of the rule book, And what's also frustrating to me is, every time you read. Really, when we got involved into real estate in a serious way, I was also a point in my life that I was reading a lot of like how to retire books and like savings, and all those books, like they kind of mentioned inflation, but they basically said like, if you just save as much money as a cappuccino a day, you'll retire a millionaire by the time you're 65. If you start like by your time.
Yeah, but what's a millionaire isn't what it used to be either, right?
They never really addressed the whole inflation thing. They kind of said, yeah, well, you have to account for inflation. But if you account for inflation, like 30%, somebody was doing the historic inflation rate on me a little while ago. And they're like, yeah, if you want $200,000 in annual income when you retire, for your family, and you want like a nice healthy income of $200,000, that's actually like, if 30 years from now, you actually have to plan for like $380,000 or $400,000 in income. And that's only at like a 2% inflation rate, right? If you're planning out 35 or 40 years. So that changes how much you have to save absolutely massively. So I guess.
So I was just talking. So sorry, finish your thought.
No, I was gonna transition into like, can this continue, and look at some of the numbers.
Okay, so this kind of leads into the can this continue too, because it's one of the reasons I was watching the election. Multiple reasons, obviously, and what was interesting is that the Liberals, their platform was 4 years ago. Their platform was, we're going to balance the budget in 4 years, right? Was it 4 or 5, something like that? Now their platform is like, we kind of screwed that up. We're not going to balance in 4 years. And we're not going to balance. It's going to take us, instead of 4, it's going to take us like another 20, So they came out and said until like 2022 or somewhere in
I even missed that. Is that what they've said?
It was somewhere in that decade, I believe, that their projections were like, that's when there's going to be a balanced budget now, which blows my mind, because like, it wasn't that long ago we're balancing the budget, even with the Liberals. Like, remember when Chrétien was in and Paul Martin was finance minister?
I think they were the best tandem at it, man.
Right,
that was like a unicorn moment for Canada,
because they fiscally they manage things really well, right? So, but it's not a political statement, liberal, conservative.
No,
whatever.
but I think they had to, because in the early '90s, I think Canada was close to the IMF coming in, because we were so out of control. They were at one point, and then the Liberals kind of took it.
But then anyways, they did a good job, and it used to matter. Like, people used to care about that, but this time it seemed like I read the different polls about what people cared about. And I don't take those with a grain of salt, but budget was like way down the list. Like, no one cares.
This doesn't impact you today.
Yeah. So and what's interesting is, if they're going to create all this money or spend all this money, this deficit spending, they know they can never get it back unless they inflate the debt away. So by the Liberals winning, to me, I'm like, okay, well,
inflation's going to go.
Well, this game's going to continue, because they know they're going to continue. So like, I was watching it that way.
You bring up an interesting point, because I wonder if the people who don't care, I wonder if they realize that if they're having kids right now, and then they don't care about this, but the only way not to care is for the Liberals or whatever government's in power to just keep spending, right? We don't care about the deficits. We don't care. Keep spending. But if you have kids right now, that means that when your kids are due to buy a house, you're going to look around going, what the heck?
Yeah.
The homes used to be $1 million in Mississauga, and now they're $2 million. And you're just going to kind of like blame the government. But you were the ones who voted for people who are, or a government who doesn't care about deficits. But then again, nobody knows about this stuff.
I know.
No one talks about it.
But the pharmacare and the free daycare spots and all that stuff, that's what's causing, like there's some underlying truth to that's what's causing it, and I'm not saying get rid of those. Like, look, I'm not saying like, people need those. This isn't a political statement. Have them, but I'm sure there's a lot of other inefficiencies in the government. Remember, I used to work at the government. Right?
I used to work at the government too.
Yeah, and in my, and I wasn't high up in the government. I didn't get a good look behind the scenes at all the different books and financials. But from what I could tell on the front line, wow, were there inefficiencies? There was money to be saved, that's for sure. So I'm not saying get rid of that stuff or anything. I realize the social value of that, but it does. I just think it comes with a cost. And at least if everyone's aware of, okay, guys, here's the cost. We're going to do this, and 10 years down the road, here's the cost of it. And then it's a more informed decision, right?
Yeah. Here's the cost. All your kids are screwed. No one will be able to afford a home. But then I guess the flip side is that the home that you happen to be living in, if you already own a home, is going to like double in quote unquote value or price or whatever. So those people are going to be happy. Basically, anyone who owns assets is always going to be happy in this environment.
As long as they're good ones.
But you don't want to own shit assets. But you're right. But so there's something I wanted to call out here, is that something that we look at all the time is, can this trend continue? Like, is it possible for like inflation in this kind of spending to continue? And we often look at the U.S. deficits because basically the Bank of Canada follows what the U.S. does. There's sometimes a little bit lag, but historically, if you go like the last 60 years and you get a comparison chart between the Bank of Canada's lending rates and the Federal Reserve's lending rates, it's always kind of mimicking each other. They never really go to whack too much. I think there's a brief period in time, maybe in the 80s or something, where they kind of diverge just a tiny bit for a little bit of time. But overall, Bank of Canada, in Canada, we mimic what the U.S. does with its interest rates. So as a result, we spend a lot of time focusing on the U.S. budgets and their deficits, because that's going to dictate what they do with their interest rates. And the Congressional Budget Office put out this awesome summer report in 2019, this past summer. And it basically said that from 2019 to 2029, so for the next 10 years, they are projecting that the annual deficit is going to be about 5%. of the gross domestic product of the US. And they have this very flat, even line saying every year it's going to be 5%. Every year it's going to be 5%. And then if you look into that report a little bit more, this is what kind of baffles my brain. If you look, it shows you the actual budget deficit in the US of $823 billion as of the year 2018. And then it shows by 2029 that it is $1.4 trillion. And then if you do the math on that, it's approximately, and I am rounding here, but it's approximately a 6% growth rate. So if the budget is going to increase, the deficit is going to increase. So the government's going to spend more than it takes in tax revenues. And that increase of the deficit is going to increase 6% a year. How can they show a chart that shows the average deficit's just going to remain like flat? It would have to assume that the gross domestic product or the economy in the US is going to also grow at 6%. Like unless my like grade 8 level math here, and maybe I'm being confusing when I explain it, but you can't have something grow at 6% and something else that you're comparing it to, the economy, grow at a different rate and show like that they're in sync together. So for the economy to grow at 6% to match the deficit increase, that would be an astronomical growth rate. So I looked at the forecasted growth rate of the US economy as per the Congressional Budget Office, and it's 1.8%. So they're saying the U.S. economy is going to grow at 1.8%. And by the way, they always screw that up. Like they always screw it up.
Well, they change it every 3 months.
They change, too. Yeah, it's always changed. But if they're as low as 1.8%, and that's pretty low for a positive spinning Congressional Budget Office, and the budget deficit is going to grow at 6%, that's a delta of like 4.2% or 4% if I'm kind of rounding it. So if you compound that 4%, the deficits are going to get out of control even crazier, which is going to add to the $22 trillion in debt that the U.S. already has. And this is why I think they can never raise interest rates. The only possibility of raising interest rates would be some sort of crisis in the bond market, which would be like a separate conversation altogether because that's a legit financial crisis.
And again, when you say, I just want to be clear, because when you say raise interest rates, you're so matter of fact about it. And I think I agree with you, except they can raise interest rates, but it's minor. Like you mean a major move because they have raised interest rates. I don't mean like a quarter point or a half. I don't even mean a point. I mean, they can't raise them like 3%. Yeah, because they have raised them over the last couple of years. Now they're cutting them again.
Yeah.
But yeah, so there can be small moves, but to go into what was considered the normal, quote unquote, normal interest rate environment.
Yeah, back up to 5 or 6%.
That's. I mean, don't think anyone sees how they can do that. Right?
In 2007, we were getting mortgages at like 4.8, 5.2%. Like no one. And look at it this way: it's pretty simple. If the U.S. budget. If the U.S. debt is at $22 trillion, a 1% interest rate move would increase payments on the budget deficit, would increase interest payments $220 billion, because 1% of $2.2 trillion is $220 billion. Okay? So if 200...
No, that's 10%.
10%?
$2.2 billion.
No.
Would be 1%.
No, 2.2 trillion is 10% of 22 trillion.
Oh, 22 trillion.
22 trillion.
Yeah. Okay,
sorry,
right.
22 trillion.
22 trillion.
A 1% increase in interest rates would mean the interest payments increase now we're messing it all up. $220 billion.
Yeah.
Now, stick with me here. The annual budget deficit of the US currently is like 800 and some odd billion. So that means if interest rates were to go up 1%, you're increasing the deficit of the U.S. with a 1% interest rate move by 25%.
Over 2 trillion. Over a trillion.
Over a trillion. But if you raise interest rates 4%, you're doubling the annual deficit just on interest payments. So this is why when people tell me, like matter of factly, like economists talk about it, we've had bankers in front of
Are their tax revenues up or down?
The tax revenues, I had this stat.
I
think they're slightly down because of Trump's tax cuts, which gave a bump to the economy. But it's kind of lowered tax revenues a little bit. Don't hold me to that exactly, though. But if you speak to an economist and you just say, well, how are they ever going to raise interest rates? Because a 4% raise would just double their annual deficit. It's just kind of blank stares. Like, I don't get it. So the only way they're going to be able to raise interest rates is if they inflate the economy bigger and faster. So I think this inflation thing is kind of here to stay because it's the only card they have left to play. Because if they can't, the only options you have when you have that much debt out in the world is what? Like you either pay it back through growing the economy, like the normal method, like let's grow the economy in a healthy state and like pay back our debt, which doesn't seem to be working because the debt's growing faster than the economy. But that's like the normal thing. Grow the economy through like actual real growth. Or you default. You're like, shit, we can't pay back this debt. It's just too much. They're never going to default because that means Wall Street and the banking sector goes under. So the third option, the only third option that I can figure out is you inflate it away, meaning you grow the economy artificially through pumping more money in and let asset bubbles form all over the place. And if you're kind of smart, you see this coming, you play the game. It's like this game of hot potato, but that's kind of like their only play because the economy doesn't seem to be growing naturally faster than the debt, and they're not going to default. So this inflation, I guess my thinking is that, and I'm just thinking out loud, like I don't even know if any of this makes sense. Listen, if you're listening to this, we're not economists. we just like looking at this kind of stuff. But it feels to me that they're just going to inflate their way out of this. And you're right, Nick.
Sorry.
No, I was just going to answer your point. Like tax revenue, the U.S. federal debt as a proportion of tax revenue is at its highest all the way back to if I only have the data going back to 1945 when it was 5.6 times tax revenue, and now the debt as a relation to tax revenue is 11 times. I think that's the highest on historical record.
Yeah, but that means that's like you earning, let's say $50,000, but you have a credit card that, the interest rates are lower. So let's say you have like mortgage debt or just a regular simple line of credit that is, $550,000. Mm-hmm. How long is it going to take you to pay off the $550,000 when you're making $50,000 a year? Just think about it. Right?
Minimum payments all the way along.
Yeah. Well, the Canadian government mismanages $330 billion every year. That's our income, right? That's what they kind of fritter away. I guess probably I can say 10% of it's probably smartly spent. I don't know. It's my answer.
Yeah, like you know what, we need the healthcare and stuff, but let's
healthcare, roads, like there is some stuff, but I just
federally, I don't.
When I hear
who
just
pays for our police, municipal. Peel.
Regional.
It must be regional.
Yeah, municipal.
Okay.
It's regional.
Yeah,
right?
okay.
But it's just when I hear about the studies that they commissioned another study for $30 million to like determine something useless. I know. Do we need something?
Sometimes I think about that, like how much money we waste on committees, but then I think, damn, like some of these committees we need, because if I was making an important decision, I would need a freaking committee of some sort. But I know they waste a lot of bullshit.
No. Don't forget the OCB. Ontario Cannabis Store.
Oh yeah, the logo.
Do you remember that?
Yeah.
What was it? What did it cost?
I think they spent $300 or $400 or
$650,000. If you're around a computer, or if you've seen the, so they came up with two things for $650,000. They hired a firm that managed to kind of like brilliantly just kind of name the marijuana sales in Ontario the Ontario Cannabis Store, because that's like very, creative. Like no one thought of that. And then they came up with a logo that was like an OCB, and that was pretty much it. Like it was just crazy for $650,000. It blew my mind. That's the type of stuff that freaks me out. Like what marketing firm got that contract and spent $20,000 in salaries?
Yeah, like I'm so two-sided on that, because I'm like, yeah, that's an absolute waste of money. But at least the marketing firm was hopefully some private company that earned it, and they made some money and hopefully spent some money.
No, I know. I'm happy for them too. Yeah.
If I was the marketing firm that got that, yeah. Oh my God.
But that's
you could go to Fiverr.com and get a logo for $5.
Yeah, no, I know. Well, what about the $1 billion to cancel that gas plant thing from Delta McGuinty, and that right before the election? I mean, it basically came out, and then they hid all the files. Remember, they deleted hard drives. No, because
I like to avoid that kind of stuff because it just irritates me.
Yeah, but it went to court. They deleted hard drives and stuff. He got away with it. Someone else, one of the other guys, got tried. But it's crazy. Like the amount of waste just blows my mind. Okay, what are you going to rant on next? I got lots of good.
Okay, no, I don't know. Pick something.
Here's something that this goes back to just the cost of goods that we were talking about before, because I was curious. I'm like, look, I wanted to go back just 10 years, not too far. And because I wanted to see the impact of these low rates and where things are. So I took I took about 10 years ago, it's about 11 years ago now, that rates when they started coming down. And at the time, I don't have the exact interest rate I used, but I think it was about the 5% mark, somewhere where you said that was like the posted rate, right? Because remember, we were getting mortgages at that time. So when I took roughly that rate, and I took today's rate, I took the latest mortgage we renewed at, or one that we renewed a couple months ago was 2.79.
2.79. Someone just got one at 2.59. They told me, I don't have firsthand knowledge. I was told that.
Yeah. So when I took those two rates and I went for 2009, I said, okay, let's take a mortgage amount of $500,000, and I punched it in. I'm like, $500,000 mortgage amount. What are my payments? And it's $33.49. Well, 10 years later, when I took today's mortgage rate, I'm like, okay, how does the mortgage rate really impact things? 10 years later, the 33.49, the same monthly payment carries a mortgage of 724.
And what was it before? Carried a mortgage
500.
What? So yeah,
it's almost 50%.
50%.
Yeah, just under, like fully high 40s.
And the drop in rates. So how many? What percentage in drop in
probably
rates?
Probably rates might have been cut in half, probably, because 2.74, I think it was about 5. So just right around half. Somewhere in that range. But I'm like, yeah, it's no wonder that, and then the government's like, yeah, what's going on with housing? Well, what do you mean what's going on with housing? Look, you guys have caused it.
It's not rocket science.
So, but it was surprising to me that it was that much of a difference.
Yeah. Wow. So that means if rates go from 2.79, because we think through our own research, we've been doing some research that we recently shared. We don't have time to go into it here, but one of the Your Life, Your Terms events, we just shared how through some of our research, we think the central bankers in the U.S. are fully prepared to go from 2.7 or wherever they are now to like 0 or even slightly negative or 0 with a lot of quantitative easing to make it negative so that real rates would actually be negative.
So the payment of $33.50 in that case, then it goes way over $1 million.
Yeah. So we might have one more solid run on real estate here over the next few years as they continue to drop rates. I mean, that's crystal ball speaking, which is just pure guessing.
Yeah, so rates is one thing, and then we have to look at supply and demand, and the economics that are going on here. And right now, those favor, and the shortage of supply favors property holders, landowners, anyone with real estate. So now those trends can change. Like we're always kind of...
Yeah, paranoid. We're straight up
on
paranoid.
A weekly basis. I think we're looking at different things, saying, okay, what's going on now? You know what I mean? But the initial forecasts are nothing's kind of jumping out saying, oh, here's a red flag. Like it looks like this trend's ready to change now. Like anything they can change immigration laws tomorrow, and all of a sudden immigration goes from 400 down to 150. That's going to change things very quickly.
Totally.
But nothing's jumping out. Like the Liberals won. The chances of them doing that probably pretty slim.
Or there could be a bond market crisis where people just decide, screw it.
Totally.
Give me my money back. I'm not buying any of these bonds out in the market anymore. And then rates just kind of spike up. So we're totally not talking about any of that stuff. That's the kind of black swan event that could happen at any time that we're totally not talking about. And that would be the way that fixed rates could really go. Like that would be the event if the bond market just said it puked on itself. Then rates go jumping high. And then all the analysis we're talking about goes in the reverse. Yeah. Because if the rates go up now 2%, the property prices come down the 50%. Yeah. Holy shit. Yeah. That's scary shit. And they, you know what, that for them to fully come down that much, it would have to mean there's a lot of sellers. People are going to have to live. But that's a sketchy environment. Yeah, the only thing, so yes, 100% that's sketchy. 100% there's things like that can happen. Well, look what happened in the U.S. when the mortgage market just dried up because of all those crazy mortgages, right? Which I don't know if you want to share after, or maybe you did already on a different podcast, just about kind of we're seeing some of those kind of coming I'm just
back.
About to share it.
Okay, so but before you do, the only thing that comes to mind in that type of scenario, I guess, for myself, so, cash flowing properties, they cover themselves, income producing properties. In that scenario, the property prices come down. The economy is going to be so screwed, right? Like it's not going to be real estate that's hit. So when real estate's hit like that, the whole economy gets screwed. That's a good point. We focus on real estate, but it's a broader thing. Yeah, so the economy is going to be totally screwed. Are those properties, to me, going to be even more valuable from an income and wealth generating place or not? And I guess maybe because
why? Because you're thinking.
Well, because I have these income generating assets still that are paying for themselves. So the value. You might have one of the only valuable assets in the economy. Well, yeah, because the economy is so screwed. Like if we're talking one of those black swan events where things get really hammered, nothing happens in a vacuum. You know what I mean? A drag. There's another number of other things, and I'm not saying I'm right. It's just a thing that I play in my head because I actually fight with myself back and forth. I'm like, well, yeah, I see the good side, but I'm like, well, I see the shitty side too. So I kind of fight back and forth with it. Like, which one is it? You know. Anyways, yeah, these mortgages. That's super interesting. Okay, so here's what I wanted to talk about is that everyone listening to this might not pay attention to this, but you might have seen a headline about something called the Repo Market. And here's what's happening. Banks need to lend to each other overnight. It happens in Canada. It happens in the U.S. And in the U.S., when they lend to each other overnight, and by the way, they do that just to kind of balance their books.
when they lend to each other overnight, it's very short-term lending. So like if one bank lends to another bank, I don't know, $10 million, the other bank says, okay, you know what, can you just show me some collateral because I'm just lending this to you overnight, but show me something on your books that makes me feel good that I'm going to get the $10 million back in case you can't pay it back. You have some other collateral that's going to act on behalf of that $10 million. And they just kind of lend to each other overnight. It's a very liquid market. It's the Federal Reserve's overnight lending rate is used to dictate the interest on that market. So it's a very technical thing, but at a high level, just know that banks lend to each other to balance their books overnight. I know someone's going to be listening to this and say, Tom, you generalized it way too much, but we can gladly go into a much deeper dive on that at another time. But here's what's happened over the last 2 months. The overnight lending market has started to seize up. And when it first started seizing up, people were freaking out because we're like, banks should be able to lend to each other overnight very easily. And some excuses came up like, oh, it's like, the end of the month is coming up and there's some tax payments that need to be made and there's just a shortage of liquidity in the market. And it was supposed to be like 2 or 3 weeks. Well, this has gone on now. Nick, I think it's like mid-September. I feel like it was mid-September. The Fed is like active in the overnight lending market every night at this point, and there doesn't seem to be an end in sight. And the bank is the Federal Reserve is specifically saying, even though we are printing fresh money and pumping it into the repo market overnight, do not call this quantitative easing. This is not quantitative easing. Don't call this quantitative easing. And I'm like, holy shit, what the hell is happening here? And then on top of this, right about the middle of August, we had a friend of ours come up from Florida. And we did a podcast together. And Nick, I still can't remember if it was on the podcast or before or after, but he said something like, hey guys, like subprime is back.
I think it was on the podcast.
Was it on the podcast? And we're like, what the hell are you talking about? Subprime lending is back. Subprime lending is what almost destroyed the US. And he's like, no, subprime lending is back. And we're, after the podcast, Nick and I did some research into this, and we find that there is this kind of subprime loan. And I'm going to read you this one paragraph because it's from this Real Estate News. It's an August 21st, 2019 article. The headline is this: mortgage market reopens to risky borrowers. And if you read this paragraph, listen to this. It says, largely gone are the monikers subprime and Alt-A, which are a type of mortgage that earned the nickname liar loan because so many borrowers faked their income and assets. Now they are called non-qualified or non-QM because they don't comply with post-crisis standards set by the Consumer Financial Protection Bureau for preventing borrowers from getting loans they can't afford. So basically, they're not called subprime anymore. They're called non-qualified or non-QM. And then Nick and I did a little bit more research and we dug up the level of these types of loans. And in 2008, there was right before the kind of crisis hit, there was about 65 some odd billion dollars of these things. And then in 2009, it dropped to 10. So it literally, like, the market just almost evaporated, dropped way back down. But then if you look in 2010, it got less. It actually went from 10 to went right down to about 8. But then in 2011, it starts increasing again. And every year it starts crawling itself back up. It's a little uneven, but the last 3 or 4 years it's gone on fire. And in 2018, there was 45 billion, almost back to the 60 billion that was the year before the crisis. So even though they're called non-qualifying, or some people are calling them unconventional loans, all these subprime lending or bad kind of mortgages are back in the market. And so much so that the U.S. Senate, the Banking, Housing and Urban Affairs Committee in the U.S. Senate in September 2019, they actually had a committee to talk about this stuff that got hardly any press. And there's this one federal housing director, Mark Calabria. He has this quote. It says, I will tell you as a safety and soundness regulator, when I look at $3 trillion institution, and he's referring to Fannie Mae and Freddie Mac, who kind of like guarantee these kinds of mortgages, not all of them, but they do a bunch of them. At a $3 trillion institution that is leveraged 1,000 to 1, it keeps me up at night. He's saying that they are less equipped for a downturn today than they were in 2008. So like, it's kind of creepy to know that, like, not only do I think rates are low and they can't go high because of the deficits, there's in the background, the repo market is kind of like, showing signs of like something's not right. Like some banks don't like the collateral. And then it got me thinking, oh my gosh, is the collateral in the repo market that some banks are using some of this funky unconventional mortgage
which is
stuff?
what caused all the problems last time, right?
Yeah, which is what caused all the problems last time. So I'm like, oh my gosh, are we like on the verge of another one? And then I'm like, oh, well, how long can they keep it together? Because if you think we're on the verge of another one, who knows? It could be 5 years before anything happens. And they can keep lowering interest rates for another 2 percentage points before they hit zero. So all of this mashed together makes it like very complicated and very crazy. But the bottom line to me is, let's say there is some weird lending crisis going on between the banks. What's the move by the central bank in the US? They're just going to print more money. They're just going to keep rates low. And even if the bond market starts to like gyrate a little crazy, they're going to step in and buy the bonds because they can't afford interest rates to go higher. So inflation over the next 10 years, maybe it's not going to be 2%, 3%.
There's potential that it could get worse. I mean, there's potential that it could less too. Yeah.
Totally. There's potential it could go either way. I just mean the kind of kindling is there for inflation not to be 5 or 6% over the next 10 years. The kindling's there that it might be much higher. So like maybe our projections of like, that $500,000 house, maybe in 10 years, it'll go to like 1 million. And we're like, holy crap, wouldn't that be crazy? That'd be 5-6% a year compound. Maybe we're wrong. And maybe we're like undershooting, because if inflation comes in higher, that's going to be too low. And I know anyone who's listening to this who is anti-real estate is going to think I'm a pro-real estate person and like real estate can do no wrong. No, I'm not saying that at all. You have to buy smart. You have to make your real estate portfolio recession-proof. You have to buy what Nick was saying, income-producing properties that pay for themselves. You can't get carried away and just buy anything. I'm just like brainstorming out loud on this episode, just thinking like, holy crap. Is the kindling there for inflation to go like even higher than even what we're suggesting it could? Because a lot of people think we're crazy with some of our projections.
We have a property by McMaster, one of the properties by McMaster that you used to call like it's the $1 million student property. It's going to be the $1 million student rental, and everyone kind of laughed, right? Remember
we used to
at
laugh.
Team meetings? Well, I remember sitting in the back boardroom at our old office, and it only held like 6 people.
Yeah,
that was the team meeting.
Totally, yeah.
And you kind of said that, you mentioned it, and everyone kind of laughed about it. And it was bought at $250, and we overpaid for it at $250. We made a mistake at that time, but that was 20 years ago now, or so, that we bought that property. It's now tripled in value.
Yeah.
Right. That property has tripled in value. And we've done outside of routine maintenance. So we've done updates to keep it at a standard
we've done
level.
Actually a fair bit.
No, we have done a fair bit, but we've done nothing that's
structural.
We've done nothing that's increased the value of the property. We haven't added more rooms.
Yeah, no additions.
We renovated some kitchens and stuff just to keep them on par with just normal kind of wear and tear stuff, so we haven't forced appreciation of that property in any other way by adding a floor or that type of stuff, right? So just like typical standard appreciation, what's happened in the last 20 years, that property's tripled in value. So it's some of the things that when you said it at the time, it seemed insane. And looking back, you're like, I kind of see it makes sense, right? So it's something that it can be very hard to kind of look forward sometimes and understand it.
Yeah.
Right? But again, it's not a straight line, and this has been a good run, and we're very, we understand that. Like things don't go straight like that. Now,
I like how both of us just roll our eyes when we give out the disclaimers.
Well, because people,
we're just talking.
Well, because people are like, well, did you think about this, and this, and we have we try to counter our own arguments all the time. Do you on a regular basis, right?
Yeah, and people do criticize sometimes, saying, I think one of the Rockstar Minutes I put out, I said, there's been no correction, and someone's like, no, there's been a correction in 2010, and there was 2012 and 2017, and to be fair, prices did go, there was Oakville townhomes going for $1 million in 2017 that are now going for $895. I'm not talking about that.
Yeah, but that's not. But so yes, you're right. But that was pocket specific, area specific, and property type specific. Because in some areas, those starter townhomes didn't move at all. They actually kept increasing the entire time. They didn't come down in pricing at all. Right?
Totally.
So and you're talking correction.
I'm talking correction across the board,
yeah.
Where there's a massive freeze of the real estate market, where basically real estate transactions, like the volume, get cut in half for over a year, like a year or 2 years. I'm just counting some kind of serious stuff. But anyway, so just kind of circling back to that whole U.S. comment, because the U.S. is in the state it's in, it makes me just then think the Bank of Canada is also not going to be able to raise interest rates because of the state of the U.S. and their fiscal situation in the U.S. We're kind of similar up here. And we can't afford to make our interest rates much different than what the U.S. does because we don't want our dollar to be really high in relation to the U.S. because we're basically export-driven economy with the U.S. being our number one customer. So we're locked into these low rates as much as the U.S. is locked into these low rates. So going forward, to me, it's just like, damn, if you don't get your income or your money you make from wages or a career into some sort of asset ownership, the next 10 years is going to be scary. And not only that, Nick, something weird.
The last 10 years have been scary.
The last 10 years have been scary.
Because if you're only based on income over the last 10 years, you've missed out on a big chunk.
You've missed out on a big chunk.
Great.
And it hasn't really been your fault or anything. It's just kind of happened.
Yeah. So if the next 10 years were to be like the last 10 years,
which it looks like there
could be, the gap can widen even further.
Totally. And it's kind of why, I talked to, I know your kids are a little younger, but my son's now finishing high school, and I've talked to him now regularly. He has an account that he's saving for his first rental property. He always asks when you bought your first one, by the way.
Because he wants to beat
Because he's quietly competitive, so I think he wants to beat you. But
I think he's openly told me that.
Does he?
So yeah.
So he's working and saving up his money to buy his first asset. But I just mean, I just feel like if there's one thing we can introduce into our education system here, it would be like, hey, choose a career that you love, do things that you love, go into the healthcare field if that's your thing, go into whatever it is, but take some form of your income and save it so that you can buy assets. And the reason that this kind of also bothers me a little bit, Nick, is that I feel 10 years from now, look, you and I are middle-class Mississauga kids, born to immigrant parents, just basically trying to survive. Our parents, basically, I would consider poorest of the poor type people who came to
in their
this country.
childhood. Yeah. And coming here with nothing.
Like our father was born in a bush,
yeah,
right? Like our mom did not have the best upbringing by any means. So they both came here with basically nothing. And we kind of, they got us kind of in what I would call into the middle class in Canada. And then here we are saying, hey, you know what? I think it's probably a good idea for us to buy some properties for ourselves and our families. But I feel, what's coming our way, and anyone who owns property, if you're listening to this, I feel like in 10 years, we're going to be accused of being the rich. Because you're like, oh, you're one of those people who has property that's worth this much. And it's not like any of us have set out on this journey for that reason. It's just been more survival and how can we play the money game to win it. But I feel like that's something, if you own property, if you're listening to this and you have 2 or 3 income properties now, be prepared for that. Because I strongly believe in 10, 15 years, people are going to look at you and say, oh, you're one of the lucky ones. You have like 3 rental properties worth however much money. Oh, wouldn't it be nice to be in your position? And the real impact is that no one will know the sacrifices that you went through to get those, and it'll be dismissed. And I know I'm getting on a different topic, but this is unfortunately where, when I talk about the destruction of the middle class, this is where it happens between classes as the divergence increases.
But isn't that happening? It's happening now. Like those same comments exist.
The same comments exist. I guess I just mean it's happening in slow motion right now. And I feel like 10 years, it'll have just compounded. And those conversations will be just more prevalent everywhere.
Well, we run some ads on Facebook, right? So in some of our Facebook ads, the comments that you're getting now, I mean, I know this is social media, which isn't, I generally don't spend much time worrying about what comments on social media are saying, but we do see them. And some of when you talked about the destruction of the middle class,
we see some of them. We don't see all of them.
Where we map the properties to the
income
to the incomes, right? And then we share some of that, and the comments are like, yeah, well, you guys are the reason why, like it's like people like you, meaning like real estate investors, you're hogging all these properties, people,
greedy people like you,
greedy people. Some people comment on the immigration. They're like, if these,
that's just a touchy subject.
That's different. Yeah, I'm not getting into that, but I'm just, people are always like pointing the finger, like they're already like, well, this is the reason, and not really kind of taking responsibility for themselves and looking at other people as the cause, and it's like they're holding them back, right? So it's already there. And if it's going to amplify, which is a good chance it's going to, you got to be something you be prepared for.
We're not going to have time on this episode, but I wanted to talk to you about the population. I want to ask you Canada's population growth specifics and some of your research into just students and what they're doing as around the population here in Canada. So we'll do that at another time. But something I did want to mention is that if you're listening to this, one of the most often common questions that we get about real estate would be, well, guys, if there is a correction, what happens to rent? Because that's our ultimate concern. Like if we can lock in interest rates and protect ourselves from any interest rate moves, what happens to the actual income side of the equation? If we can control some of the expense side of the equation. And from all our research in the US, when they had the big downfall, rents stayed pretty stable. And very shortly afterwards, they started drifting upwards because the demand for good properties and rental properties increased. It didn't decrease, and it increased because banks weren't lending. There was no access to credit, but people still needed a place to live. So although in places like, Ohio and some places in Florida, they had these massive downturns in property prices, there was no correlation with a massive downturn in rents. For starter homes, I want to be clear.
We've been seeing 10 to 20% rent increases over the last number of years, like each year, annually. Like think about it,
right? It's been that much.
Yeah.
I haven't really put a percentage to it.
Depending on the area, that's what it's been.
Yeah,
like
it's crazy.
They've been very, very strong.
But in a downturn, I guess is what I'm suggesting is that
I
they'll likely stay stable.
But what I'm saying is if they're that strong now, the reason they're that strong is supply and demand. So if they're that strong now and there's a downturn and people can't afford it, they have to.
Oh, got it. No access to credit. Yeah.
The demand's likely going to increase, So even if it's not, so let's say it doesn't even keep this trend today, because that trend can't continue forever. Like it just can't, right? So let's say that trend doesn't continue and it's just a fraction of that trend. Well, even if that trend is cut in 4, so a quarter of it is still a very kind of healthy, number that you can work with.
Totally,
right?
That's a good point.
So and it maybe the trend's even wiped out and it goes to no rent increases and it just stays stable. But what has to happen for it to be wiped out is a big shift. So that because of what's going on with supply and demand right now, the market can handle that big shift and not have the rents really change much. And that's part of the big reason is because we're in a rent control environment, which in any downturn will provide more stability because the rents are artificially held low anyways, right?
Yeah, crazy times, man. Crazy. It's kind of fun to be in real estate at this time with all the interest rate stuff.
Well, there's a lot of stuff to look at.
You took a deep breath when I said that. You took a big sigh. Like, I don't know. Is it really?
No, it is. It is. It's just, there's just a lot of stuff. I think what I like about it is it's a big puzzle and you're just trying to figure out the puzzle.
Totally,
that's what it is.
Yeah, I always call it like a game, but a puzzle is the best way. Like, how do the pieces fit all together, and how can you
just
make
trying
this
to figure.
work?
Like any investor, so like investors that invest in the stock, they're looking at the market, they're looking at moving averages and this and that. Like they're in the stock market or in stocks. I just realized what I said, but they're trying to figure out their own puzzle. And in real estate, it's trying to figure out that puzzle as well. It's a little bit different and it's a little bit more straightforward once you...
Well, you can control more pieces of it.
Once you have the property, you actually have something physical you can rent out. And, so it's a little bit different, but you're just trying to understand it, right? So, and the more you understand and the more you can kind of make your decisions based on more information and give yourself a little bit of an edge.
We're probably both just massive control freaks. That's why we like real estate.
No, I think we're just nerds and we like looking... I'm a nerd. I like looking at these numbers. I think
I'm definitely a geek with this stuff. But anyway... So anything else? I think that's good.
I think
we'll
that's
do
it for
the
now.
population stuff.
Yeah,
on
we can
episode.
cover that stuff for sure.
So that's it, everyone. Thanks, Nick. Hey everyone, it's Tom Kratz again. So hopefully you enjoyed that. On one of the future episodes, we will dive into the population growth numbers specifically and some of the student or non-permanent resident status students that come into the country and how it's affecting demand for real estate. I was recently traveling in New York and somebody in New York told me on how they have some friends and how they're entering the country here in Canada that just kind of blew me away. So we'll share some of that stuff on like a population increase or demand or population trend kind of episode for the Your Life, Your Term show shortly. But in the meantime, if you want some of the actual data that's coming out from this country, we have a report called Ontario's Population Explosion, The Untold Story. You can get a copy of that report and all the other reports that we've put together at rockstarinnercircle.com/reports. That's rockstarinnercircle.com/reports. And listen, if you enjoyed this episode and you haven't given us a rating yet on iTunes, we would be forever grateful. If you think we've earned and deserved that, thank you very much. If you've you've done it already. If you haven't and you could do so, we will be forever grateful. That sounds like I'm totally overpromising, but I guess we would be very grateful for that. That's it for this episode. Until next time, your life, your terms.